So, chapter 7 is usually dedicated to just the topic of cash, but the most important part of chapter 7 actually is the beginning, where they talk about fraud and they talk about internal controls. Internal controls. And so it's really important to understand what they mean because this affects everybody. It affects everybody. Okay. So we are going to be focusing in on basically the first two objectives. Everything is really kind of in the first objective. The second objective just sort of repeats a bit of the first one. So here's our starting point. The idea of understanding what fraud is. Now, fraud is a big category. A lot of things can be put into fraud. We are going to narrow our perspective of fraud into this definition. Okay. Fraud would be defined as a dishonest act by an employee, right, that results in a personal gain to the employee at the cost to the employer. Okay, so that's our definition of fraud for this chapter and this discussion. All right. So how does fraud happen? Well, there's normally three factors that are involved in which they've identified are really important factors that contribute to fraud being fraudulent activity happening. Start at the very top. The word opportunity here simply is that employees are given the opportunity to handle various assets of a corporation. Okay. What assets are they handling? Well, they're certainly handling cash, as we just mentioned, but they also are handling supplies of the company. They're handling inventory of the company, and they're handling various property, plant, and equipment types of things for the company. So, in terms of employee opportunity to literally handle certain assets of the company, that is true across the board. The most the most opportunity really kind of lies with cash because cash is one of those types of assets that is sort of hard to formally trace to a particular person. So, for example, if you were walking down the hallway and you or walking on the street and you looked down and there was a $20 bill on the ground or on the floor, you probably wouldn't pick it up, put it up in the air, and say, "Hey, did anyone drop a 20?" Because about 10 people would probably raise their hand. Oh, yeah, it's mine. We normally wouldn't do that type of thing. We normally would just say, okay, someone dropped a 20 and now it's mine, and thank you very much. Cash is normally seen as owned by the person who is handling it, right? When you have a $20 bill in your hand, I'm assuming it's yours. That's how it works. That gets a little tricky when it comes to handling other people's cash. Right. And that happens pretty frequently in businesses where you're actually handling cash that doesn't belong to you. How can they tell? So cash in essence is the most vulnerable asset out of all of them. You can trace supplies to purchase orders. You can trace inventory to purchase orders. The same with various equipment. You can trace all of that through purchase orders of how the company got it. But cash is one of those vulnerable assets, which is why this part of the discussion, fraud, is part of the cash chapter because it's the most vulnerable asset. So that's the opportunity piece. Another piece is just general financial pressures that employees have. Look, we all have financial pressures. We live during a time in our history where the costs for basic stuff is expensive. The cost of housing, the cost of transportation, the cost of healthcare, the costs of food and daycare, education, things like that are relatively pricey. Even going down and getting a cup of coffee you might need to drop $3, $4, $5 to get a cup of coffee. That's a little pricey. So we're all sort of under financial pressure. Now, when you and plus a lot of people are living, I think about half the population during one of the last studies I've read are living paycheck to paycheck. So think about the financial pressures that they're under as well. Then add to that the wonderful human condition that we have. We are, in essence, sort of prone to developing various wonderful addictions that cost money, such as smoking or doing drugs or drinking to excess, right? Or just wonderful other types of addictions like gambling or just going shopping. Why? We don't need it. We just like going shopping. It's sort of an addictive behavior. We like doing it. And so, when you throw all of that on top of it, you have significant financial pressures for some people. Some of these people are handling or have access to those assets. Now, those two alone don't mean fraud is going to happen, but you're certainly on your way down the road to fraud possibly happening. How does it happen? Well, that last piece of the triangle has to happen. This idea of rationalization. What is rationalization? Well, in short or in brief, it's convincing yourself that doing something wrong is the right thing to do. Okay. So, for example, you have learned since you were, able to speak and understand as a child, and certainly when you got into preschool or kindergarten or certainly first, second grade, never take anything that doesn't belong to you. Right. That's just a very simple thing. If it doesn't belong to you, you cannot have it because it is not yours. Right. We respect ownership of property. Right. Well, in the rationalization piece here, how fraud happens is, well, this is a multi-billion-dollar corporation. They're not going to miss this $50 that I'm putting in my pocket. Well, that's rationalization. It doesn't matter how wealthy the company is. The principle is it's not yours to take. Right. That's the rationalization. So you're rationalizing that it's okay to steal and that it's not okay to steal. Same thing when employees have access to supplies or inventory of the company that they decide to take it for themselves and not pay for it. Well, I deserve it. They don't pay me that much. This is sort of like a benefit I'm giving myself for working here and taking all their crap. Rationalization, right? Because you're convincing yourself to do something that is wrong. You cannot take other people's stuff, no matter how rich or poor the other person or entity is. It's just stealing, right? So that's the rationalization. When all these three things come together, you've got fraud. Okay. When you act on all of these, you've got fraud. And so that happens a lot. And unfortunately, employee theft is a huge problem. Um, Employees take a lot more from their employers than the infamous shoplifters that are there. They exist. They're there for sure. They do take stuff, but employees know the ropes a lot better than the shoplifters do. So when this really, what really happens in the worst case scenario with fraud is that corporations start lying about their financial condition. And when they start lying about their financial condition,
Gosh.
they put together statements, financial statements that are fraudulent. Then you're talking about crime, committing a crime that is widespread because in many instances the public owns these corporations. For publicly traded corporations, this was happening, and it still might be happening from time to time. But the law now is on our side. Sarbanes-Oxley was passed way back in 2002, 2003, that area, to say, look, if you are a publicly traded corporation, which means you have stock on a stock exchange, and you put out various statements, there's a few things you need to do. Number one, the law requires all of these corporations to put into place what's called a system of internal control, and that's meant to stop fraud from happening. And that's what we're going to be talking about in detail very soon. It also said that corporate executives and board of directors have to verify and ensure that these internal controls are in place. And further, what's not listed here, but what's further, they have to sign off on the financial information that the company is providing. And that's a jailable offense if they're lying. If they're caught with fraud, um, that's a jailable offense for the first time under this bill. Another thing they have to do is they have to use an outside auditor. Now, what's an auditor? An auditor is simply an accountant, a CPA specifically, who checks the work of another accountant. Right. Now, CPAs all know the rules when they're doing financial statements because they all have to do it according to GAAP. So they all know the rules. So one CPA who's not affiliated with a company can walk into a company, look at their financial stuff and say, yeah, they're following the rules or not, because they know the rules. The rules are the same across the board. So an independent auditor means that the company has to hire an accounting firm that they don't do business with. Thus, they're independent from them. And they are hired to come in and check to see if they're doing their accounting correctly. Again, they have to follow GAAP. That's the rules for publicly traded companies, right? They have to follow GAAP. So that's what they're attesting to, that they're following the rules, and that indeed they have put internal control systems in place at the corporation to help prevent fraud. Okay. This particular act also put and created, laws by themselves don't enforce themselves. You need administration to enforce the law, and so anytime Congress acts, it has to be enforced by somebody. So they created the Public Company Accounting Oversight Board as the administration to oversee that the act and the rules and the laws are being followed. Okay. Followed by who? Publicly traded corporations. That's who we're talking about here. So this idea of internal control, and you've actually witnessed it in your own workplace, and you're free to share stories as we go. But internal controls basically are corporations need to put together methods and procedures that safeguard the assets. The most important thing internal controls are there for is to stop anyone from taking the assets of the corporation. Okay. And again, like I said, cash is the most vulnerable asset since it's handled by so many employees. But then again, supplies, inventory, etc., they're all relatively vulnerable. But cash is the most vulnerable. Surprisingly enough, since the law has been in effect, what we found is that the accounting records seem to be a lot more accurate. So the law actually has helped the accounting record accuracy in various companies. And other things that they did is companies had to look at everything that they were doing and do it better and put things in place that would stop fraud. So actually, a lot of companies got more efficient in doing things. So that's a really big plus. Companies are also required to have what we call a compliance office or a compliance officer that makes sure that the corporation is following the rules regarding Sarbanes-Oxley. Okay. All right, we're going to be looking at at a few things specifically, but I will just say that there are various components of every corporation. One is, what's the environment that's there already? Are there any methods of control already in place, and are they working? What are the risks? What are the risks that are present for potential fraudulent activities? We have to look also to not just at the environment, but at the specific activities the company has in place. Are they working? How are they communicated to others? And are they being followed? And are they being followed correctly? So that are they monitored, basically? So there's a few components there. But these are the activities that you're going to be familiar with. And
could you go back? I missed that section because I got disconnected.
I'm going to keep going, Greg.
Okay.
It's really not a critically important part. This is a critically important part here. So if you have to miss that one slide, you're okay. One thing I will tell you is that these activities are really what the homework is going to be about. So this is really where you have to pay close attention. First thing is companies have to make sure that they are establishing responsibility for various things. So normally speaking, they try to assign at least one person who is responsible for a given task. Okay. That means in the example here, for example, when you have, uh, say, clerks at a supermarket that are doing cashiers at a supermarket that are doing the register, they should all have their own cash drawers. So that way they're assigned a particular cash drawer. Um, the company, of course, has a record of all the sales that are being made and the cash that's being collected. And thus, at the end of their particular shift, they're going to be responsible for what's happening in that drawer. Someone else comes in, they're going to have their own cash drawer. And thus, that's a way in which we can establish responsibility by giving that one person has that responsibility for that task. Sometimes that's not always possible, in which case we want to limit access to things such as cash drawers to either the person it was assigned to or some authorized personnel, perhaps like their manager or something like this. And that's it. But again, if something were to go wrong, if things were missing, you know who you need to talk to and find out what's happening. That's the purpose of this control activity. Another control activity is to make sure you're separating the duties to make sure that different individuals are responsible for related activities. So no one person controls the whole activity. Okay. That's subject to fraud. When one person has too much control over the whole process, fraud can happen. When you break that up, you're reducing the likelihood of fraud, considerably. So, for example, here, when you're looking at keeping track of assets, like keeping track of cash, you would have one person who is actually doing the record keeping for cash. So they would actually have a record of it, keeping track of that. And another person who would actually have the physical custody of the cash. That way, these stories obviously should match, right? But this is a way to segregate the duties to protect anything bad from happening. It doesn't mean that something couldn't go wrong. It just reduces the likelihood. It's all about reducing the likelihood. There's really no such thing as zero risk, right? That you're reducing the likelihood is what you're trying to do. Another activity that's really important that most corporations already have in place, and they need to keep doing it, is to document everything that they can so they have, in essence, a paper trail to follow to see what, if anything, was missing. So companies need to use, pre-numbered documents so everything is accounted for. Employees need to sort of sign off or be part of that documentation process. So it actually helps them saying, yeah, I did see this, I signed off on it. Um, and again, part of it is the idea is you have to make sure that you're putting in place activities that reduce the likelihood of fraud. Okay. You've all been subject to and probably have your own stories of physical controls that you know about or been subject to. Probably what everyone has been subject to one point in time is your time card. In many companies, they still keep physical track of with either a time clock or you either swipe in, you swipe an ID to clock in and swipe an ID to clock out. Either way, this is a record of your time at work. Why is this a control activity? Because if you don't control the hours of the employees, they could say they worked more hours than they did. And that's stealing. That's stealing. When you say you worked 8 hours today when you only worked 6, you're stealing 2 hours from the company. Um, Again, that's rationalization. Oh, they owe it to me. Rationalization. Uh, it's stealing. Bottom line. So time clocks are meant to be a physical control to help reduce the likelihood of fraud with time cards. You've already worked in buildings that have had, that are quite secure, have lots of alarms, other types of things to make sure that nothing gets broken into. Because particularly, I mean, if you're a retailer, all that inventory is how you make a living. So you certainly don't want anyone to take it, right? So making sure that your buildings are secure is also very, very important. Um, Now, I mean, part of the building being secure is not only the store has to be secure, but your warehouses have to be secure. Um, your warehouses are where most cases, all your supplies or inventory is located, and you want to make sure that is locked. So you might not necessarily have an alarm system there, but you probably do have some type of locked warehouse where limited access goes in. Only a few people have the key, right? So you kind of know if anyone's in the warehouse, you kind of know who's already there because you only issue the keys to so many people. So
Um, what
yes,
about cameras? Would cameras not fall on this list?
yes, I'm getting there for sure. On cameras are on the side here. So when you're looking at television monitors, which are cameras, or tagging, various inventory, you're basically doing that to deter theft, right? You don't want anyone to take something that's yours without paying for it, which is the right thing to do, right? So this is basically where that would fall into as well, Greg. Um, Not only do they have these, they also have, secret shoppers and other types of things that go around as well. For a lot of businesses, you still have a lot of restaurants and bars that handle a lot of cash. There are some businesses that are cash businesses, normally maybe even a barber shop or something like this. Um, and so basically, they would want to have a safe. I think that basically, or a vault or some type of safety deposit box, that would be only accessible by certain people, right, to keep their cash safe. And also just to get in or to do various things, whether it's to get into a store, get into a warehouse, or even operate a computer or a cash register or whatnot. Oftentimes you have an access code in order to get there. So you're identifying yourself that you're the one who's using this at that time. Or it might be a fingerprint or eyeball scan or something that identifies that you're the person going in at this particular time. So again, that is a control activity because you're going to be the one who's responsible to make sure everything is okay. For larger companies, they're able to actually do what we call independent internal verification. Let's go back to our employees, this one who's managing the books and keeping track of how much cash the company has on the record, where this particular employee is the one who's holding on to the cash records, right, having the physical cash on them. There might be a third party involved who can independently monitor and see if those things are going well, and if not, they actually report any differences, any discrepancies to management, so these things can be handled. Human resources are actually a very important part of the internal control activity, which you probably would never consider, but it's true. Think about all of this. First of all, um, I'm going to link the first and the last one together. First of all, we're talking about bonding employees. So here with bonding, we're not, we're far away from 50 shades here. We're talking about insurance. Bonding of employees is simply by having insurance policy on an employee who handles cash, right? Employees who handle cash, that's the most vulnerable part of the job because can you trust all employees to do the right thing? Sadly, you can't. So if employees take cash that belongs to the company, that company wants to be insured against any losses. So bonding employees is simply an insurance policy on an employee who handles your assets like cash or inventory. Now that ties into the background check. Specifically, background checks are really important, particularly if you have a record. Now, background checks for criminal offender records, for example, usually um, will show any convictions of crimes. What they're looking for is, were you convicted? In other words, found guilty of stealing. So petty theft or embezzlement or anything that revolves around stealing something from someone, because then they wouldn't be able to insure you. They wouldn't be able to give you the job because you're just not insurable, and so they're not going to hire you because they're not going to be able to get insurance on you, and because you have a record of taking other people's stuff, they have a right to say no. And so that's really important to understand how those are connected. Background checks are just not, oh, he was a good employee because he worked for me. That's all nice. References are really, really nice, but it's really about, are you insurable? Are you risky, or are you not very risky? That doesn't mean that you don't have a record and you start stealing when you work for them. Okay, terrific. That those things happen. Again, there's no such thing as zero risk, but you can limit the risks, and this is a way to do it. Another thing that human resource policies do to help with internal control is, I'll start with the requiring a vacation. Requiring vacations of employees is very important because things should work the same when they're not there as when they're there. And when all of a sudden an employee is on vacation and you start noticing some differences, maybe there's the person who's covering for that employee perhaps might be collecting more cash, for example, on their shifts. That might be an indication that some theft is going on, right? That some fraud might be going on. So requiring vacations allow the company to sort of monitor. You think they're probably not thinking about you on any vacation. They are thinking about you. They're not thinking about you very highly. They're just thinking about you. And so they're looking to see if there's anything that is different when you're not there. The same thing in rotating employees to different jobs. Usually, when you're rotating one person out of another job and another person is coming in, they're the ones who are going to notice anything that's different. And that reports then to management. Management knows, okay, you're stealing or something like this is happening. So, believe it or not, even human resources is involved in making sure that fraud is not occurring. Okay, fascinating stuff. Well, you're going to be here. This is a big part of your homework, is you're going to be given a lot of information on things that are happening, and you're going to have to decide which measure, internal control measure, would have stopped it from happening. Okay, so it's kind of looking like CSI meets accounting. So you're kind of putting on your detective hat as well as you're doing accounting here. So here is a person who was a training supervisor for colossal healthcare. I would say that like really loud. Colossal healthcare. So what did this person supervise? Claims processing training. So this person would train people who were learning how to process claims at the healthcare company. Okay. So how did they do that? They created fictitious claims. So trainees knew how to create those claims. Unfortunately, it was on their live system. So these claims were sent directly to the accounts payable department for payment. But after every training class, Maureen would notify accounts payable that, XYZ are fictitious claims. Don't pay them. These are part of my training. However, she did not always inform the accounts payable department that they were fictitious and allowed the payables department to pay the claim. Unfortunately, when they paid the claim, they made it out to an entity she controlled. So she was pocketing all that money. How much? $11 million. That's a colossal amount of money. And because it's a healthcare company, I think it would make them pretty sick. They might be looking for insurance themselves. But taking $11 million over time is a huge fraud. Is a huge fraud, right? What would have stopped this from happening? The missing control is, right, establishing of responsibility, right? They they basically allowed, they didn't restrict Maureen from doing all of these types of things. So she had the ability to authorize claims, she had the ability to approve claims, and send it directly to the accounts payable department for payment. The company also should not have used their live system. They should have had a training system set up, a dummy system where they can practice, and not a single one would have gotten paid. So bad on them. Here's another anatomy where you have Lawrence Fairbank, we'll just call him Larry. Larry is the assistant VP of communications at ASOP University. And this assistant VP was allowed to make purchases of under $2,500 for his department without the external approval, which usually is coming from, some finance department or something like this. Unfortunately, Larry liked antiques and other collectibles and would go ahead and buy them, right, on Aesop's watch. He then would create a vendor invoice that looked like a real invoice. And it would simply, he'd submit these with the regular invoices and they would get paid. Okay. So he took almost $500,000. Now that is quite an education for Aesop University. For this guy to grab almost $500,000. That's a lot of tuition, no doubt about it, right? Well, why? Well, because Laurie could do everything. They never segregated his duties. He was allowed to not just order items, he could receive the items, he received the invoice, and he could submit it for payment. And so he could manipulate that along the way. That's a problem. All of these duties should have been separate. Someone else should have been responsible for ordering items. Someone else should have been able to receive the item and document that they received X, and then paying of the invoice. So these duties were not separated; they were all in Larry's hands, and Larry just liked to go shopping apparently. This is another situation where you have a person who was an accounts payable clerk for a construction company. Not only did she prepare the checks, she also reconciled the bank statements. Remember, the bank is the one who pays the checks. So if you're the one who is writing the checks and you're the only one who is looking at the bank statement of those checks being paid, you're the only one that knows, right? So unfortunately, she wrote checks for things that didn't occur. Okay. After the supervisor approved and signed the checks, she would go ahead and white out the pay line and change it to an account she controlled. And of course, she was able to conceal this for a very, very long time because she's the only one who knew that the checks were cleared by the bank and no one else knew. So how much did she take? Well over $500,000. That's a construction company. That's a nice big house. Okay, for sure. She stole a house from the company. And basically, it's again separation of duties, right? She was the one. She had physical custody of the checks. Plus, she prepared the bank reconciliation. She was the only one who saw what the bank paid on those checks. No one else could see the check was changed and paid. Only she could. So she was able to get away with this for quite some time. Another fraud here shows a company, there were employees at Mod Fashions Company who traveled a lot, and that's true. That's true. And so the company would reimburse certain travel expenses, like for meals. Um, and employees were required to submit receipts. The problem is they could submit a detailed bill for the meal or the credit card receipt or a copy of the credit card statement. Okay. So a number of designers got together and came up with a scheme. That's what collusion is, by the way. When you have a number of people say, hey, we're all in this together, let's do it together, and they all agree. That's collusion. Um, so, for example, this is how they colluded. If they had a meal together, for $200, one person submitted the detailed meal bill from the restaurant, another person submitted the credit card receipt, and a third person submitted their credit card bill. Right. So they all of them received $200 instead of just one person receiving $200 for whoever paid. Right. So that's a $600 meal. That's a lot of bread. How much did they take? 75 grand over time. That's a lot of food, no doubt about it. Lots and lots of food. What was the missing control? Well, their documentation procedure was bad, right? Because what they should have done is simply require the original receipt only that original receipt. No photocopies, no statements, no nothing. One other thing they could have done to help is they could have just given those folks the corporate credit card for business expenses rather than a personal credit card. That's a good way to limit what people can spend, is because everything they spend on their travel shows up on the corporate card and the corporate account. And of course, that can be monitored quite easily. So that's another thing that they could do to stop that fraud. Okay. There's a few other frauds here. Again, this particular fraud, they took $250,000 from the mail room of all places, right? Um, again, lacking some physical controls. The mailroom wasn't locked. People had access to it. Trouble can happen. This particular one here, the take was another, $250,000. Why? Because there was no internal verification. It's a very large company. They can afford to do that. Again, when people have too much control, things can happen. This is another situation where you had a desk manager at a hotel and the head of housekeeping at a hotel. They were best friends who decided to clean up, literally. How's that for a joke? May I take your reservation? Yes, I'll take some money, please. Thank you. So basically speaking, they never, ever, ever took vacations. That should be like a huge red flag. Why don't you want to get out of this place? Right. Well, because this place is very lucrative to them. Right. So in essence, basically they took almost 100 grand from this luxury hotel. That's a few nights stay for sure, depending on how luxurious it is. The missing control was human resources. They had not done a background check, um, first of all. And then the second thing, the only way they detected this is because Ellen was too sick to come to work, and they found it out. They found it out. So these are really, really important things. You're going to be, again, your homework is going to be very much like that. Okay. There are some limitations. Internal control systems and activities, have some limitations to it. One is that, yes, there's benefits to setting up internal control, but there are certainly costs involved. And so the costs of setting certain things up should never really exceed the benefit of stopping that fraud from happening. Size of the business is going to matter as well, because you have, some businesses that they're corporations, but they're smaller. When you have a smaller place of business, you rely on a lot of people to do other things, and there's a lot of blurriness um, involved, and so there's more potential for fraud to happen in that. So, but the size of the business matters. As they get larger and larger, it's much easier to segregate things. It's much easier to do this. But if they're still smaller and they're growing, it's harder, really hard. And of course, again, like I said, the human element, there's no such thing as 0%. You're never going to stop fraudulent activity from happening 100% of the time. The purpose is to block it, try to put blockages in the way so it discourages it from happening. But that human element is always there. We are imperfect people and we do imperfect things. And, that's part of it. And we have imperfect systems. So a lot of your homework is going to be very much like this. They're going to ask you which control activity has been violated. Again, you're going to read the situation and understand what the solution is on all of them. And so that's basically what your homework is going to focus on here. Learning objective 2 does the exact same thing, but for cash. Cash coming in is a cash receipt. Again, very important that that's established well. There's a lot of ways in which cash receipts are controlled to make sure no one is taking them. Okay, including open when you have a mail receipt opened by two people and just stamping everything for deposit only. So you kind of know what's going on. Having people sign off on things, really important. And then a cash disbursement is when payments are going out. One thing that you can do is use the banking system. It's EFTs are all recorded. When you pay by check, you also have a record that you can look at. Of course, they have to be checked, right? Another thing is to use a voucher system. So again, every single disbursement is controlled, and that's really all this kind of goes over. One thing I will share with you is some details on how employees steal. The most common is the first one here, and that we call it asset misappropriation, but basically it's theft. I did have this here, and it's misappropriated. In other words, someone took it. So basically, this is the most common thing that happens, whether it's theft of cash or purchases or other types of things. It is the most common. However, thankfully, it's not as costly as the other types of fraudulent activity that happens. The most costly is what I was talking to you about very early on, why Sarbanes-Oxley was enacted. Financial statement fraud is the worst. It is the worst because it's all made up. The profitability, how strong the company looks financially, is all made up. And so that leads to companies going under in many instances. So it's the least frequent type of fraud, but it's certainly the most costly. And certainly right in the middle, you have good old-fashioned corruption, bribery, illegal gratuities, extortion, all types of wonderful stuff that we do as human beings. So the middle number here on this chart is what we call the median loss. So again, asset misappropriation is the most common type of fraud that happens on the job. But again, 130,000 is the median loss. So a median is the middle number in a line of numbers. So if you line your numbers up from small to large, the median is the one in the middle. So for example, if you had three numbers like 1, 2, and 3, the number 2 is in the middle. That's the median. So 130,000 is the median, which means half of the losses were bigger than that, and the other half were less than that. Still, it's a lot. As you see, not that many financial statement fraudulent things happen, but certainly it's the most costly. The median is $1 million per fraud is the median. So that's a big ouch right there. So that's a general overview of the controls. That's what your homework is going to be focused on in general. So I'll stop that recording, but we'll talk a little bit more about if you have any personal experiences with this.